track record of new discoveries, and upgrades of resources, a track record of upgrades of resources to proven and probable reserves. Speaking of track records, our company has a track record of consistency across several measures. Clearly, exploration successes and increasing mine lives, as I mentioned, but there's also production and costs, our guidance and meeting those guidance expectations, and financial performance. Since 2014 to today, as we upgraded our portfolio of mines, changed our management construct quite significantly, we promoted certain management and we completed several succession plans. In that period of time, we also executed on plans for balance sheet improvements and creation of financial resilience. And we've consistently delivered across all of the areas that are important for a mining company: resources growth, reserves growth, production goals, cost expectations, cash flow, and mine development. And with our strong and resilient balance sheet, we have consistently paid a dividend, and recently we've begun to increase that dividend. And throughout all of that time, we've maintained a focused commitment to health, safety, environmental observance, and governance. But I have to say, I can't do justice to our ESG effort in just a few moments of this presentation. We do have a new materials issues report, which describes our efforts on health, safety, environment, and community relations in great detail. That is on our website and on the public file. This is our 13th year of filing that annual materials issues report. We've begun a campaign to market our efforts to investors on ESG, given its prominence and importance as well. But as a summary, our total injury and lost time injury rates are down significantly year over year. We focus on lead indicators, an example being high incidence reporting, essentially recognizing and reporting possible or near accidents that do not occur, near misses. And that's to develop lessons learned, helping to create a health and safety culture. We are developing climate change action plans at all of our sites. In terms of water, we recycle water by comparison to freshwater consumption, of one being a multiple to the other. Recycled water is 3 times the amount of freshwater consumption, and that has improved dramatically over the last few years as well. We have a significant decrease in greenhouse gas emissions. We employ and procure locally with many social programs. We engage with local communities actively. We have no upstream tailings facilities in our operations, and we conduct monthly, clearly constant audits, but in terms of corporate reviews, at least monthly regular safety audits. In terms of the overall precious metals portfolio, we have 5 producing mines, 1 in Northern Canada, 2 in Chile, and 1 in each of Argentina and Brazil. Our production ranges at each from about 80 to 90,000 ounces per year to 330,000 ounces per year, depending on the mine. 2 mines produce silver and gold, 3 gold only. 4 of the 5 mines produce, or are now on a path to produce, over 200,000 gold equivalent ounces per year. 1 is a large open pit mine, although with recently discovered underground ore bodies that are under review for development as a new underground mine. The others are underground with comparable mining methods and plants. As I mentioned a few moments ago, we are, in addition to gold, a significant silver producer also. Something is well understood. It's well understood that silver outperforms gold in a rising metal price environment. Silver is up almost 120% from March alone. It's an ace up the sleeve of a company that produces silver in addition to gold. It perhaps provides a positive impact on cash flows. The part of silver overperforming gold in a rising gold price environment is, I believe, well understood. But this is not well understood, at least not yet. With between 10 and 11 million ounces of silver production in our company, that impact is huge. We budgeted at the beginning of this year under $20 per ounce of silver. So at $30 per ounce, roughly where silver price is hovering today, our margins increased by $100 to $110 million. And since our costs are flat, we're producing the metal anyway between gold and silver concurrently. This almost entirely goes to our cash flow bottom line. I call this our souped up torque that is not well understood. And we intend to communicate that more effectively. So overall then, we are a 1 million ounce producer between gold and silver with costs at just above $1,000 per ounce. Both production and costs this year have been impacted by the pandemic, with 2 operations subject to governmental orders, temporary orders for reduced activities. Both of those operations have since resumed operations. In all jurisdictions in which we operate, mining is considered either de facto or by law an essential service. Historically, all-in costs have been below $980 per ounce, and we expect costs to trend back to those levels as production resumes to its normalized higher levels, beginning this quarter, but in particular in the fourth quarter and into the next few years. A little bit on our strategic mine life index. That index takes into account all of the factors for mine lives. It includes reserves, but it also includes resources and several conversion factors based on historical conversion of resources to reserves. The open pit at Canadian Malartic has a 7-year mine life, but at already more than 10 million ounces, the underground will likely support a long mine life of several decades. Jacobina has reserves that already support 16 years of mine life. And each year in the last several years, we have converted to reserves a multiple of what we've mined. Between reserves and resources, with a track record of upgrades and conversions, internally, we carry 20 years of mine life at Jacobina. El Peñón is really interesting. It's an epithermal vein system, no surface outcroppings, difficult to identify where there is mineralization and then ore bodies. It has had, in its 21 years of mine life, in any 1 year, no more than 6 to 8 years of reserves per year. It is the gift, however, that keeps on giving. Today, based on reserves of just over 6 years, additional resources, about 25% of mining every year that is outside of reserves, and a rate of addition over what we deplete every year of about 1.5 times, we estimate a mine life in excess of 10 years. A reasonable estimate is 10 to 12 years. Cerro Moro is our youngest mine, and we have an active campaign for increasing mineral inventory. Internally, we estimate close to 10 years of mine life. Although until we advance the exploration program, as you see on this slide, we allow 6 years. Minera Florida is our smallest mine. It has had significant exploration successes, however, in the last 3 years, giving us line of sight to at least 9 to 10 years of mine life. And incidentally, I should mention that reserve estimates have been and will continue to use a gold price of $1,250 per ounce, well below where the gold price is trading today. To say it differently, when we make new discoveries, we will be making new discoveries. And when we increase reserves, we'll be increasing those reserves based on the drill bit, not based on a change to the metal price assumptions. For a while, on to our strong financial performance. In the first half of this year, we generated over $340 million of EBITDA and $280 million in cash flow. And in that, $150 million of net free cash flow. To me, more meaningfully, is our annual sensitivities. Using 1750 gold price as a reference point, we generate $100 million more in EBITDA and $70 million more in cash flows for every $100 increase in gold price. And today we're trading at a gold price that is at least a couple of $100 higher than that reference point of 1750. And as I mentioned a few moments ago, increases in silver price add to that. And our first half of the year was affected by temporary suspensions at 2 of our operations with government orders relating to the pandemic. Most of the time, more than 54% of our production normally occurs in the second half of the year. This year, we expect it to be higher. And continuing on with our financial metrics, even with a weaker second quarter to first quarter because of operational suspensions and then the ramping back up of those operations, our second quarter margins increased. This shows a very strong expectation for the second half of the year with bigger margins and that higher level of production. Capital allocation is important to us, and we have three capital allocation priorities: balance sheet management, managing organic growth, but with low capital costs, and increasing dividends, and then keeping those dividends, once increased, sustainable. So let's begin with our balance sheet and the financial resilience to which I referred a few moments ago. Starting at the center here, we are an investment grade rated company, and we have been since we launched our first bond offering in 2014. Our net debt to EBITDA leverage ratio is below 1 turn of our EBITDA and trending substantially lower. And even with a reduced production volume in the second quarter, we decreased our net debt. We have no debt repayments that are due until 2022. And even then, a modest $190 million, which is due in that year, which we intend to repay with internal funds. We ended the second quarter of this year with about $325 million in cash and almost $1 billion of total liquidity, and that is expected to continue to improve. And adding to that is we have several projects that are under evaluation outside of our mines, several monetization initiatives, and significant value creation opportunities at our mines. So let's begin with our mines. Jacobina is engaged in a second phased expansion that takes production up another 50,000 ounces to 230,000 ounces, and that will cost us a modest $57 million beginning late next year for roughly 15 to 18 months. Again, very manageable. Canadian Malartic's underground is under evaluation within the next 3 years for a large planned underground mine with 10 million ounces in inventory and reference points. There are scores of these mines in Northern Canada. We expect a large production platform, certainly in the range of and likely exceeding 400,000 ounces per year. A good estimate would be between 400 and 500,000 ounces per year. And while this is deep and requires a shaft, there are conventional approaches. And as I mentioned, there are scores of comparable mines in Northern Canada. It's not difficult to estimate what to expect from the ore body. It's not difficult to estimate the CapEx, which should be in the range of, for our 50%, $375 million. So 3 years out, before any significant spending needs to occur, we would be spending $375 million over 4 years of development. So just about a modest $95 million per year for a production platform that would be at least 400,000 ounces per year for the entirety of the mine and for several decades of mining based on 10 million ounces in inventory already and increasing. These projects deliver exceptional returns. I should mention once again that they were evaluated at a $1,250 gold price. This gives us short-term and intermediate-term production and cash flow growth, but it also gives us immediate increases in net asset value and enterprise value, as a modest amount of these aspects are reflected in public valuations. In terms of our other operations, we are at this juncture extending mine lives. But for El Peñón, we're also looking at something else. We have excess plant capacity, and as our resources inventory continues to increase, we will bring some of that, or at least look to bring some of that forward. Since 2016, we have been processing at a rate of 2,800 tons per day to as much as 3,500 tons per day. But plant capacity is 4,500 tons per day. Production has already increased from 145,000 ounces of gold and 4 million ounces of silver to 165,000 ounces of gold and 5 million ounces of silver. But we still have plant capacity from 3,800 tons per day to 4,300 tons per day, meaning that we can bring the production platform of El Peñón to a higher level with zero cost for investment in the plant. That plant is already there. And into the intermediate to longer term, our generative exploration program kicks in. In the next 3 years, we expect at least one of 7 opportunities, 2 in Canada and 5 in Brazil, to reach a resource level of at least 1.5 million ounces. 2 projects already have resources. And the objective is to build a mine plan of at least 150,000 ounces per year for at least an 8-year period on that resources platform. The point here is that we show short, intermediate, and longer term growth with very manageable capital financed through internal cash resources that include cash flows. And looking at some strategic opportunities, starting from right to left, we have monetizable investments whose carrying value exceeds $200 million already, and other development stage assets that will drive value either by whole or partial monetizations, development, or both. And it's important then to have a discussion of what that does. But to summarize, we not only have internal organic growth at low capital costs that feeds and increases our cash balances, we also have resources to supplement our cash flows to further increase those cash balances. And this gives us financial flexibility. It gives us resilience. We are fully funded on our business plan. And that brings us to our approach on dividends. We have consistently paid a dividend since its inception, just over 13 years ago. Dividend increases as cash flow increases. And even in periods of low gold prices and uncertainty, say from 2013 to 2016, we continued to pay a dividend. And today we're looking for certainty. And part of that certainty on the dividend, given that we are price takers, we're not price makers. We do not regulate or know what the price of gold and silver will be. We've created a dividend reserve fund that does that, creates that certainty. The idea being that we would keep cash reserves on our balance sheet that for at least a 3-year period, we can pay for dividends even if gold price were to decline. So we care about the sustainability of our dividend, which is why we've consistently paid it, and why we've created this cash reserve fund on our balance sheet to pay for the dividend independently of gold price. But we look at dividends holistically as part of overall returns. It is the cash portion of those total returns. We have paid over $940 million of dividends since we first paid a dividend in late 2006, so just over 13 years ago, as I mentioned. And that is amongst the highest, if not the highest, of all of the gold mining peers in our sector. And our returns in that period of time since 2003 has been a whopping over 900%. And more recently, since early 2019, over 170%. So I understand the question that begs. It does beg this question. With that type of performance, is there more to come? And as you see in the conclusion of this presentation, across every measure of value determination that is relevant to our industry, price to net asset value, price to cash flow, price to revenue, enterprise value to EBITDA, we are still inexpensive. With an improved asset portfolio, a management structure that is fit for purpose today, a strong balance sheet and a well-articulated business plan, and a commitment to returns for shareholders, a re-rating began last year in our company, and I strongly believe that that will continue. Some concluding thoughts before opening this conference discussion up to questions. We are listed on the Toronto and New York Stock Exchanges, and we have now applied to list on the London Stock Exchange as well. The listing in London fits in our themes and objectives, and we believe that those themes and objectives are consistent with the expectations of UK and European investors. We plan to earn the trust of those investors to become the investment of choice on the London Stock Exchange. We offer operational consistency, long life, sustainability, and financial excellence. And that will support a continuing value upside and strong shareholder returns. Ladies and gentlemen, that's my presentation for today, and I'll open it up to any questions.
Many thanks for that, Peter. I think we've just got time for a couple of questions that have been sent in from the floor, and they're both to do with your listing on the London Stock Exchange. The two questions is firstly, when do you hope to have this process finished by? And secondly, perhaps you can elaborate on the sources of liquidity that listing on the London Stock Exchange will open up to Yamana Gold.
Yeah, so let me begin with the second question, Andrew, and that second question is important. We do not intend to raise money. We don't have any need for cash, as you can see from the presentation that I have given. We have ample resources, ample cash on our balance sheet, and that will continue to increase. But we think that there's an excellent opportunity for investors to buy stock. We're a very liquid company. And we think that there's an excellent opportunity for investors to accumulate positions, particularly institutional, but also retail investors to accumulate positions. How does one create liquidity? Very similar to what happened with New York. When we listed on New York and kept our listing on Toronto, volume almost immediately increased. And it wasn't that we split the pie a certain way, we increased the size of the pie. And we expect that that will continue here. We see as our obligation that we have to come forward and present ourselves and constantly be present with investors. We have to constantly be presenting ourselves and providing an update. We intend to have that presence in London, whereas we were coming before perhaps once every 4 to 6 months. We would be there on a much more regular basis, encouraging investors to be looking at buying stock and then trading that stock on the London Stock Exchange. So I can't say at this juncture what will be the liquidity on the London Stock Exchange, but I can say, given the appetite to date, that it seems as if there are considerable numbers of institutional investors, but also retail investors that are interested in this process. On the timing question, that is a regulatory issue. It will depend on the regulatory review, but we've already filed a prospectus. We've completed a competent person's report with evaluation of our assets. We expect that listing will occur within the next month to 6 weeks. My expectation remains that by the end of September into mid-October, we will have completed that process.
Peter Marrone, Executive Chairman, Yamana Gold, and headline sponsor of Minds and Money, thank you very much for your time.
Thank you for your time, and thank you for listening.